Welcome back to Investing Talk Podcast.
Today we're looking at Milestone Pharmaceuticals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah.
Milestone, what we're really talking about here is a pre-commercial biotech company.
Right.
And they just hit probably the most important inflection point you can imagine, FDA approval. And for you, the listener, you have to realize this approval just completely shifts the entire investment thesis.
Absolutely. It's that classic binary event story. And our mission today is really to cut through the noise on this one. We're going to analyze why the risk profile has fundamentally changed, like overnight.
Yes.
And what that means for their market size and maybe most importantly, their financial runway heading into 2026.
Exactly. So we have to start with the baseline financials. As a pre-commercial company, Q3 2025 showed zero revenue.
Of course.
As expected. Completely expected. The company is loss-making by definition.
Right.
And that's not a surprise. It just reflects the huge investment they have to make in R&D and now building out their commercial team for the launch.
So you really can't look at this with a normal PE ratio. It just doesn't apply here.
Not at all.
Which means, if you just look at the losses, it seems scary. But what's getting everyone so interested all of a sudden in a company with no sales, it's that inflection point you mentioned.
It's the FDA approval for their lead asset, CARDAMYST.
Mm-hmm.
That news just de-risks the single biggest variable in the biotech space.
It totally transforms the thesis.
It does. We're moving from asking, will the drug get approved, to a much simpler question. How well can they sell it?
Okay, so what is CARDAMYST?
It's positioned to be the first and only self-administered treatment for something called PSVT, or paroxysmal supraventricular tachycardia.
That is a mouthful, but the condition is, well, it's a pretty common cardiac arrhythmia, right? A rapid heart rhythm issue.
It is, and the key words here are self-administered. That's the whole story.
A total game changer for patients.
A profound one. Commercial launch is slated for Q1 2026. And, just a small point on their financial discipline. Even before the approval, their Q3 2025 non-GAAP loss per share was actually much better than expected.
Oh, really?
Yeah, it was a 12-cent loss versus a 17-cent consensus.
Okay, so as Signals management knows how to control costs, they run a tight ship even when they're getting ready for this huge launch. But that discipline is only useful if you have something big to launch. So let's build out the bull case. What's management being so disciplined for? What makes this drug a potential blockbuster?
The why is all about the current standard of care. I mean, right now, if you have a PSVT episode, it's terrifying. And your only option is an immediate, incredibly stressful and expensive trip to the emergency room.
The dreaded ER visit?
Precisely.
Yeah.
And once you're there, you wait, and the treatment is usually an IV drug, adenosine, which basically shocks your heart back into rhythm. It's a massive burden on everyone.
And CARDAMYST just sidesteps that whole process.
Completely. It's an intranasal spray. A patient can use it themselves at home the second they feel symptoms.
And the data backs this up.
Oh, the data is very strong. It shows rapid and effective conversion back to a normal sinus rhythm. The median time to get back to normal was just 18.5 minutes.
18.5 minutes at home versus hours in an emergency room. I mean, that's not just an improvement. That's transforming a multi-$1,000 hospital event into an at-home therapy.
That transformation is the competitive moat. And what's really important is that this moat is protected.
Protection is everything in this space. So how long is their runway without competition?
Milestone has patent protection on etripamil, which is the molecule, all the way out to 2042.
2042, wow.
So you have this combination of strong IP, great clinical data, and being the first mover. It's a very defensible position.
Okay, so that covers the PSVT market. This is where I think it gets really interesting, right? This isn't just a one-trick pony.
That's a crucial point. The same molecule, etripamil, is also in a phase 3 program for a much, much larger market. AFib, RVR, atrial fibrillation with rapid ventricular rate.
And to break that down, AFib is a way more chronic and widespread condition than PSVT, isn't it?
Significantly more. I mean, the PSVT market is in the hundreds of millions. But if you can get into the AFib market, you're suddenly playing for billions.
Billions with a B.
Analysts think a successful AFib program could push this whole franchise toward multi-billion-dollar peak sales. That's how you build a real platform moat.
So an investor isn't just betting on this 2026 launch, they're getting exposure to a whole cardiology platform that could be massive by the end of the decade.
Exactly. And a win in AFib would also make doctors more comfortable prescribing it for PSVT. Success builds on success.
Okay, let's pivot back to the financials because a big specialty launch like this is very expensive. Do they have the cash to pull this off without just diluting shareholders to death?
That's always the number one question. They exited Q3 2025 with about $82.6 million in cash and equivalents. So, a good buffer.
A good start. But here's the kicker, right? The FDA approval unlocked a huge cash infusion. Tell us about the $75 million.
Yes, that $75 million isn't a loan or new shares. It was a royalty deal they structured, and the payment was completely contingent on getting that FDA clearance.
So now that they have it,
Now that they have it, that cash comes in, and it massively extends their runway well into the commercial launch phase.
so it's essentially
Right.
non-dilutive funding. They sold a piece of future sales instead of selling more stock. That is huge for current investors.
It is. But, to give the full picture, they do have debt. It's pretty standard for this stage. Long-term debt is around $56.7 million, and free cash flow is, of course, negative, about negative $9.8 million a quarter.
And the debt-to-equity ratio is up there, around 2.8. That might scare some people. How do you square that with the good news?
You counter it by looking at liquidity. I mean, that $75 million coming in changes everything. And their current and quick ratios are both sitting around 8x.
An 8x quick ratio is phenomenal. For the listener, that means they have 8 times the liquid cash they need to cover all their immediate bills, so they're extremely solvent.
Exactly. The debt is manageable, and now finally, you can actually see a path to positive free cash flow, which is rare for a small biotech. The story has shifted from survival to growth.
Okay, so we have a first-in-class drug, patents to 2042, and the cash to launch. Now let's play devil's advocate. Let's talk about the bear case. They did get a complete response letter, a CRL, from the FDA before this approval. That's always a red flag.
It is, and it's a critical point that caused a lot of volatility. That CRL was about chemistry, manufacturing, and controls issues, CMC.
So not about whether the drug worked, but whether they could make it consistently at scale.
Precisely. The concern was production quality, not safety or efficacy. And that's a really important distinction.
But how do we know those issues are really solved?
Well, the fact that they just got the approval confirms it. The FDA has signed off that those critical CMC issues, at least for the PSVT indication, are resolved. The regulatory risk is way, way lower now. The green light is on.
The green light is on, but a new risk pops up, right? Commercialization risk. What are the biggest hurdles they face heading into Q1 2026?
Two big ones. First is payer coverage. They need to convince insurance companies to put this on their formularies at a good price. If patients can't get it covered, the launch will stall.
And the second hurdle must be changing doctors' habits.
You've got it. Cardiologists are conservative. You're asking them to stop sending patients to the ER, a habit for decades, and instead trust a patient with a nasal spray at home. That's a big educational lift.
A huge marketing push.
Well-
So how has the stock reacted to all this drama?
Well, it's been volatile.
Huh?
The market was basically pricing it like the FDA decision could go to zero. We saw a lot of dip buying once it looked like the CMC issues were getting fixed.
Which makes the setup now very different.
It creates what traders call an asymmetric setup. There's a pretty clear support base that's formed between, say, $2.40 and $3. The downside feels somewhat contained, but the upside, if the launch works.
Could be very big because so much failure is priced in.
Exactly. And technically, the RSI is neutral in the low 50s. So the stock isn't overbought. It has room to run if they get some good news on sales.
Okay, that's a great look at the psychology. So, looking forward, what should we be watching for over the next, say, 12 months? What are the catalysts?
The immediate focus is all launch execution starting Q1 2026. We need to see, 1, wholesaler stocking levels. Is the drug getting out there?
Okay.
2, final pricing and label details. And 3, most important, those first payer coverage decisions. Those will set the tone for the entire revenue ramp.
And what about that billion-dollar shot on goal, the AFib program?
Yeah, investors will be watching for any news on the resumption of that Phase 3 program. Remember, they paused it to focus on the PSVT approval. Getting that back on track reignites the long-term, multi-billion-dollar story.
And with an approved, de-risked asset, you always have to think about M&A.
It's where the speculation becomes plausible. CARDAMYST is a perfect bolt-on acquisition for a big pharma company that wants an instant cardiovascular revenue stream and a high-potential pipeline.
They'd be a very logical target.
A very logical target. And we should also keep an eye out for ex-US partnership deals, for Europe or Asia. That could bring in more non-dilutive cash.
And you've got macro tailwinds, too. If rates start coming down, that helps these growth-oriented biotech names. And Milestone is a freshly de-risked commercial launch story right when that could happen.
So to summarize the whole thesis, Milestone is making that critical turn from a speculative clinical name to a specialty pharma growth story. They have the money, non-dilutively, to launch a truly differentiated product that literally changes the site of care. And they still have that massive optionality in the AFib market.
So the question now really isn't will the drug get approved anymore? It's how quickly can Milestone change physician behavior and get them to stop defaulting to the emergency room? That's the real challenge to watch. Make sure you subscribe, like, and comment to keep up with all our analysis.